Hello, this is a video about corporate modeling, and this is an introductory video. I have a thing called my website. I have a thing called Basic A to Z online course. Now that sucks. Now that's the only way I can say it. So I'm teaching a class and I'm practicing on making a little bit better presentation. Now, for me, corporate modeling is not nearly as structured as project finance modeling. And here's what I'm going to try to do. I'm going to start with, and each time I go through a subject, I'm going to try to discuss some different theory. I'm going to describe why McKinseyan academics are full of shit. Okay, and I'm going to start with just some general theory about stock prices. I've gotten in trouble for this in my classes before because it looks like I'm just messing around with some stock prices. I want to really do modeling, but I'm going to give you some background on really what the history of some general stock prices relative to bond prices, relative to GDP, relative to corporate profits are. And then we can take some of this and look at some individual stock prices. And I'm trying to use some India case studies. Maybe you'll get a hint of where I'm trying to have the next class on this. Now, after the uh, introduction, I'm going to go through some ROIC, return on invested capital stuff, and really step back and think, please, about why you compute ROIC. It's not some stupid little formula. It's because you're trying to figure out how well the core business is doing, not the cash they have on the balance sheet, not investments they've made in some other assets. What's the real business doing? And anybody who says there's one single formula and an easy way to do this is, again, full of crap. Now, I'll in doing that, I'm going to describe a little bit this theory, and this is a scatter plot. This one has ROIC on the side and growth on the top, and you can see the big blue things is where you make the most value. The white things is where you have negative values. And I'm going to talk about practical ways to get the ROIC. And here's the way in one of these websites they computed ROIC. This is what they had, and this is what I had. And I think the stock price trend maybe follows a little better. Talk about practical things, and then I'm going to go through an Amazon case study because their ROIC has changed dramatically. Then after we kind of get data into the model, that's all about getting data into the model and making a first couple of calculations. Then we do something about the assumptions, and I see stuff like this. What a bunch of crap, S&P. This tells me nothing. I want to know about surplus capacity, obsolescence, changing cost structure, fraud, industry getting obsolete, which I've kind of repeated, and then we'll talk about how to make some assumptions. And this is ancient history, but in the 1970s, I used this, and they had all this history next to the forecast, and that's what we're going to show you kind of how to put in a model. Okay, and then we'll talk about modeling in a really structured way rather than a haphazard way where you put different sections. In this case, it's extremely simple for EBITDA, CapEx, plant balances, and then cash or debt. And some criminal behaviors in modeling, of which this is. You notice there's a hard-coded number, and then we'll go through the difficulty in depreciation and some cash flow balances and waterfalls. Then we move to valuation, the definition of cash flow. What should you do with provisions, deferred taxes? Some things a little more complicated, and then go through all the philosophy of terminal value. This crap, ROIC equals cost of capital, and get out of the business, you idiots. And then different ways to stabilize them. Okay, now let's answer some fundamental questions about valuation and economics and uh, and finance, specifically about what this IRR really means, specifically about what kind of overall stock price increase can really be obtained, and what really is the difference between investing, what's the risk difference and the return difference between investing in bonds and stocks, so forth. Now, to do this, we'll use a file that I have open right now that I've shown you before. This file comes from, if you go to the website, you go to retrieve databases, and it's the comprehensive stock price. Now I've made some revisions to this, so I'm going to, after I make this video, attach the new file to it. Okay, and I struggled for years with this file. Now, in this file, you can read data from economic series. Perhaps I'll make it a tiny little bit smaller. You can read data from stocks. You can read commodity prices. You can read indices, stock price indices, and you can get them from either the Federal Reserve data, from Yahoo data. There are a couple of options to read data from Google finance websites, but they changed, and it turns out that Yahoo really, if you can read it from Yahoo, when you go through this, we're going to go through these graphs a lot, but pretend you're starting from just scratch. And if you're starting from scratch and would like to get some indices, you got to go to this blue area. So we'd like to look at what's happened to a couple of the overall stock indices and be able to compare individual stocks to them. We can get some of the same sort of indices from this reserve data. Excuse me. And then we have an important area where the whole idea really of getting data yourself is to be able to completely do anything, hit it over the head, use it, and you look in real terms, adjust. Many of the series are in local currencies, so we need to be able to adjust for the local currencies. And then we can compare the stocks to commodity prices. I've got a few here, but you can get many more. Here are all the kind of commodity prices you could look at. Maybe you just want to only look at them. And then we have I put a whole lot of individual stocks. I'm skipping over the Google stocks, and that's what you have. Now, if I wanted to read a different stock, for example, excuse me, I've got a list here, but you could read it yourself. So I've got a number of stocks from India here, some big US stocks, some European stocks, and that's that. Okay, so here's what you do. If you were once you have your list of stocks together, then we can really analyze them in this page. We're going to click this one that says clear all the indices. Clear all the sheets, excuse me. Okay, I just click on that one, and then we can get the complete new updated data. I hope you see. And then I kind of put it here so you can read from it. There's just a macro. This macro uses workbooks.open, And what it does is it goes, and you can see it's just putting the data into separate sheets that eventually will be summarized with the indirect function. So if we want to read from, instead of Google, we want to read from the Federal Reserve database, we just click on this one and it puts them in the same sort of format. And this is really the innovation behind this whole thing, is that you can compare all sorts of different data. I hope you're seeing that the data is all arranged as time series, and in this particular case, it's arranged on a monthly basis because I really want to look over a long-term period. Now, when I read from the stocks, there are a few more stocks to read. It doesn't take very long. You have to, there it's starting to read the stocks. But since there are 67 stocks, I'm going to pause the video. Okay, I turned the video back on, and now I'm going to make the final read, which is all of the economic data. Okay, now let's make some key valuation points that will introduce the valuation analysis. And I'm going to turn this. Oh, no, we have it. Okay. Excuse me, we don't. Let's make some conclusions about valuation. We can look at individual risks. We can look at overall economic trends for a very, very long period and try to draw some conclusions. So once you're finished, let's go to this thing called the multiple stock price graph. And what we can do is get rid of everything we had before. You press this little thing called false all. And then, it's taking a minute. And then this is the index of the S&P 500. I'm starting in 1975. Let's go all the way to the beginning. Okay. Oh. Okay. And it took longer than I thought it should take because I've got the video switched on. But that's our valuation of stocks. This was the 1987 crash. This was the dot-com. This was Lehman Brothers. And this is what's happening now. Okay, for any of the series, it looks very good. And what this implies, we're going to talk about the IRR, which is just the growth rate in the stocks. If you, every time you got a dividend, you reinvested that dividend. If you would have put $1 here in 1950, you would have gotten 147. So if you put 1 million in, you've got 147 million. 1,000, you've got 147,000. We're going to do everything with indexes instead of raw data. If I press the raw data, the line looks the same, but it gives you the value of the index instead. So if we want to compare things, instead of putting that, we put this in. Okay, you can also put now let's say I want to put this, instead of in nominal data, I want to use real data. I just click on the inflate this indices section. It really should say indices section, shouldn't it? And now you can kind of see what would have happened if you adjust for inflation. Let's go all the way back to the beginning again. That doesn't change much. So your rate of return over and above inflation over this very long-term period, including this run up in stock prices would be about 4%. Now, if you start at a different time period, you get different results. Okay, good. Here it's 3%. Starting in 1960 and so forth. Now let's compare this. I think what I'm going to do is reset this and just put this in nominal terms. Okay, and let's compare this to the GDP. And here, this is the nominal GDP in the US. So let's see how the price of stocks compared to the nominal GDP. And you can see over a long-term period, the prices here, when I start back further, there the stock prices kind of followed the GDP, and now they're much, much higher. This is one of the points I want to make. So when you get this growth estimate, and people say that in the long run the stocks can grow faster, much, much faster than the GDP, which we're seeing to say here, maybe, but the only way the stocks can really grow is if if corporate profits go. So we get another time series on, I'm going to get to just this corporate profits now. I should study exactly how they measure corporate profits and everything else. And you can see, of course, that the stock, I said of course, which is a silly thing to say, the stock prices and the corporate profits are kind of correlated until we get kind of right to the end. And in this really high period of the internet bubble, the PE ratio, really, the stocks relative to the corporate profits were very different. Now, if we stop this thing, back before the kind of government policies changed dramatically, then you can kind of see that the GDP growth and the profits on corporations were similar to GDP, and there was some fluctuation in the stock prices and all that. Now let's add one more series. Let's look at what a average household, the family income for an average household. So if we go back here, and again, this stops in 1975, a big year for me, not really. Particularly here, when the corporate profits are going up and the GDP is here, well, there's only so much room from an accounting standpoint. It's like a balance sheet. If you've got higher corporate profits and the GDP is here, you've got to go lower salaries, or vice versa. If the GDP is growing and you don't have to pay people as much, then your profits will go up. There's nothing communistic about saying that, I hope. And then if we take this series together and look at it all the way to 2018, now it's really dramatic. This is what all the politicians are talking about, and then the profits have gone up, and this has gigantic implications for distribution of income and all this. Now, the other thing we can see is that we can kind of look at the growth rates of all of these. Right now, there's the IRR difference. Let's look at the IRR difference, 7.49 versus 6.99. So that's 0.5% difference, essentially. And when we look over here, 0.5% difference in terms of the amount of money you actually get is 120 versus 88. That's a lot for 0.5%. And that's what the IRR does. This is one of my main points. So when you see a WACC table where you have a small difference in WACC having a really, really big difference in value, well, this is why it is. When you're valuing a corporation, you're valuing cash flows over an indefinite long period of time. Enough of this kind of economic stuff. Let's go and let's now take these away. Now, uh, to do all of this, you've got to use the match and the index and the lookup function, and you've got to be able to read the data in with a couple of different techniques. Now, instead of corporate profits, what I have added here is, again, we're doing this all in nominal terms. So I'm going to put a 10-year treasury. And the interest rates on the 10-year treasury are measured in this case, every month. And so I just took an index of the 10-year treasury. I guess I took the GDP off of it. So right now, if you would have looked over a very long-term period, the yield on the stocks, IRR, the growth rate on these stocks was 7.5. The growth rate on the bonds, or the interest rate you would have earned, was about 6%. Now, don't say that. You can say, oh, that's too high because whatever, the bond yields are much lower now. But that difference, let's just look at that difference. So you could say that's the equity market risk premium you would have actually earned. Let's call this 6 and 7.5. So 7.5, 6.5, 6, that's 1.5%, right? 1.5%. And that gives you 120 versus 45. That's how much difference it is. Now, if you take away kind of the recent dramatic, price stock value increases, then our difference is about 0.5%. Okay, and we can go even further back. Okay, and it's not very different, and we can start at different periods as well. Okay, and you can kind of look at what the actual equity market risk premium is. Now, when you compute your weighted average cost of capital, and people are saying, we've got a 5% equity market risk premium, or even 4%, it doesn't look very high, but over long-term periods, it is enormous. And in fact, if we go backwards here, you can just end up getting addicted to this kind of stuff. There was a negative premium. The bond rate was higher. Now, part of this is just because over this long period, there were some periods of high inflation. So I'm going to just deflate all of these, okay? And I'm, again, trying to show you what you can do once you get the data into your file. And in this case, in real terms, on stocks, you would have made 2.6%, on bonds, 3.68%. That's what you can do with all of this. Now, let's kind of clear things out, and let's just spend a minute or two looking at some stocks, rather than this general kind of economic philosophy and whether stocks can grow faster than the overall economy and all of that. So I hope I have this, and I don't know when we're going to start, and I'm going to reset all of this so that instead of putting it in uninflated terms, we leave it in, you know what I meant. Instead of real terms, we have nominal terms. Maybe that was bad. And then we're going to do a little comparison. So I would like to, comparison of, let's see how a couple of stocks. Now I'm going to pick a couple of Indian stocks. So when you put these stocks in, you have to go to Google and find the ticker symbol, the correct ticker symbol. And I've got another video on this, so I'm not going to start with this. This stock started in 2005, so perhaps we'll begin in 2006 or something like that. Okay, there we go. And we can see what the performance of the stock was. This stock had a very large increase followed by a decrease. And again, you get the IRR. Now you also get the volatility. Volatility is is standard deviation of the percent change in price in this case, adjusted and made annualized, and you get a beta of below 1, even though this volatility was enormous. And the real question is, does this beta even mean anything? Now, this is an Indian stock, so maybe we should compare it to the Indian index. Okay, and when we do that, it looks like I'm going to take this stock out for just a minute, and it looks like the Indian index it just moved right along with the US index. Now this, unfortunately, Yahoo doesn't have a really long time period. This is one of the places you might want to go and, well, I'm going to try to get it from Google or from Fred, but the chances of that maybe are not so good. So it looks like the Indian index had a very close beta, and that the volatility was slightly higher, but the index is in rupiah. And then, so I'm gonna, oops, not in euro, I'm gonna do this. And after you do this, to re-express, in this case, if the exchange rate was INR divided by USD, you would divide it by the index. If that, you know what I'm doing. I'm just putting it all in the same USD currency, and now we get a lower return. Okay, and that's really the appropriate way to look at these things. So let's put I didn't mean to put the natural gas price in, but whatever. Okay, that's kind of an irrelevant comparison. Okay, and we could compare it while I'm at it, we could compare the oil price to that, and you could, of course, compare the oil price to natural gas prices and do a whole bunch of commodity analysis. So if you were looking at a different market, maybe a market in Saudi Arabia or Nigeria or something, maybe you'd want to put the oil prices here. So I'm going to add a couple of other Indian stocks. And the stocks I'm going to add are stocks that we'll talk about, or about things we'll talk about making a financial model for in the next videos. And I'm going to get this one called Tata Motors, who now owns, I think, Range Rover and Jaguar or something like that. And we'll also get excuse me, this really big company called Reliance. Okay, and then the very first thing you can do is look at what the volatility of these things are, and we have to make sure we have the right starting point, and we have to put these in the correct currencies, and we're going to try to explain why, in terms of two things really, the return on invested capital and the growth rate, what's really happening to these stocks. This Reliance kept going up, this Tata Motors went down. Why did this Tata Motors go down? And is this beta really has anything to do with risk? Tata Motors had a 0.08 beta. The fact that Nifty 50 or the stock index had almost a one-time beta means that you can, whether you measure the beta against the Indian index or the U.S. index, it doesn't really make any difference. Are these volatility numbers a much better way to measure risk? So this is just an introduction. Let me emphasize a few points. There's how can the market really grow much faster than the economy over a real long period? I don't know. I shouldn't say anything because I'm not an investor. I don't have any money. But can the what what is the relationship between bonds and stocks over a long-term period? Is there real evidence of this high equity market risk premium because the weighted average cost of capital is not observed? Small differences in IRR make an enormous difference in the amount of money you get and therefore value. And when you look at individual stocks, how would you really think about the risks of different stocks? Does beta really measure anything? Enough of this. Okay, I get a little bit addicted to this stuff and I've got to really stop.